Look, I need to tell you about something that happened on October 24th, 1929, a day that would later be called Black Thursday. On that single morning, investors watched 12.9 million shares trade hands on the New York Stock Exchange. Now, that might not sound crazy to you today, but here's what you need to understand. The average daily volume back then was around 4 million shares. This wasn't just unusual, this was panic. By the time the closing bell rang, ordinary Americans had lost the equivalent of hundreds of billions in today's dollars. Millionaires became bankrupt overnight. People who thought they were financially secure discovered their entire life savings had evaporated. But here's what almost nobody talks about. While 90% of investors were getting absolutely destroyed, there were 3 specific positions that not only survived, but actually thrived through that catastrophe. And here's the really interesting part. Those same 3 positions survived the stagflation crisis of the 70s, the 2008 financial collapse, and even the COVID crash of 2020. Every single time markets went haywire, these 3 positions came out ahead. My name is David, and I spend way too much time thinking about how regular people get systematically screwed by financial markets while a small group of informed players profit from the exact same conditions. If you're someone who feels like the game is rigged, who's tired of watching your portfolio collapse every time there's a crisis, while somehow the wealthy seem to get richer, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to show you is going to fundamentally change how you think about portfolio construction. By the end of this video, you'll understand the exact mechanism that institutional investors use to profit during crashes that retail investors never hear about until it's too late. You'll see why everything you've been told about diversification is incomplete at best and dangerously misleading at worst. And I'm going to show you the 3 positions that have mathematically outperformed during every major crisis in the last 95 years. Now you might be thinking, if this is so effective, why doesn't everyone do it? We'll get to that. As usual, I need to tell you a story because the pattern I'm about to reveal becomes crystal clear when you see how it played out in history. Let me take you back to 1968. This is the era of the Nifty 50. Now, if you weren't around back then or you haven't studied this period, you need to understand what was happening. The Nifty 50 were 50 large cap stocks that Wall Street decided were the only stocks worth owning. We're talking about companies like Xerox, Polaroid, Coca-Cola, IBM. The pitch from brokers was beautiful in its simplicity. These are America's best companies. They have dominant market positions. They're one-decision stocks. Buy them and hold forever. Don't worry about the price. Don't worry about valuation. Just buy and forget. Sound familiar? It should, because it's exactly what you hear today about index funds and mega cap tech stocks. Here's what happened next. Institutional investors, pension funds, mutual funds, everyone piled into these 50 stocks. The concentration became absolutely insane. By 1972, these 50 companies represented a massive portion of the total stock market value. The average price to earnings ratio for these stocks hit 50 times earnings. Some were trading at 80 or even 100 times earnings. For context, that means if you bought Polaroid stock, you were paying $100 for every $1 of annual profit the company made. The math was absurd, but nobody cared because the story was so compelling. These were the best companies in America. The valuation didn't matter. Growth would justify any price. But here's the catch. When everyone owns the same thing, when concentration reaches extreme levels, you don't have a market anymore. You have a crowded trade. And crowded trades don't slowly decline, they collapse. Between January 1973 and October 1974, the Nifty 50 got destroyed. Xerox fell 84%. Polaroid dropped 91%. Even the strong companies like Coca-Cola lost 60%. But here's what makes this story so important. It wasn't just that these stocks went down. The entire market psychology shifted. Suddenly, inflation was spiking, oil prices were soaring, and the growth story that had justified those insane valuations completely fell apart. Investors who had been told these were one-decision stocks, safe holdings for widows and orphans, watched 70, 80, 90% of their money disappear. Now, who won during this period? Who actually made money while everyone else was getting slaughtered? Three groups. First, the people who owned short-term Treasury bills. While stocks were collapsing, T-bills were yielding 8, 9, even 10%. Safe, guaranteed returns, while equity investors were panicking. Second, investors who held physical gold. Between 1973 and 1974, gold went from around $42 an ounce to over $180 by the end of the decade. While stocks were in free fall, gold was surging because it was the only thing people trusted when inflation was destroying everything else. And third, the people who owned shares in essential commodity producers. Companies that made oil, natural gas, basic materials. These weren't glamorous growth stocks. They were boring, unsexy businesses that happened to produce the exact things the economy desperately needed. While Polaroid and Xerox collapsed, energy stocks were doubling and tripling. So, what does this have to do with today? Everything. Just like institutional investors in the 1970s concentrated into 50 stocks and called it diversification, today's investors are concentrated into a handful of mega-cap technology companies through index funds and calling it safe. Just like brokers in 1968 told clients not to worry about valuations because these were the best companies in America, today's financial advisors tell you not to worry about concentration because the S&P 500 is diversified. It's the same pattern, the same psychology, the same setup for disaster. Imagine you run a business with 10 revenue streams. 7 of those streams generate 90% of your total revenue. The other 3 are basically irrelevant. Now, you tell people your business is diversified because you have 10 different revenue streams. Technically true, right? But what happens when market conditions shift and those 7 core revenue streams all decline at the same time? Your business doesn't lose 10% because you have 10 streams. You lose 90% of your revenue because those 7 streams were correlated. They all depended on the same economic conditions. That's exactly what's happening in the stock market right now. The S&P 500 has 500 companies, so people assume it's diversified. But the top 7 companies represent over 30% of the index value. And all 7 are technology companies that depend on the same conditions: low interest rates, high growth multiples, continued dominance in digital advertising, and cloud computing. When those conditions change, and they will, that 30% concentration is going to collapse, just like the Nifty 50 did. Now, here's where it gets really interesting, because this isn't just about stock concentration. This is about understanding what actually survives when everything else fails. And to understand that, we need to talk about the villains in this story. Because make no mistake, there are specific groups that benefit enormously from keeping you concentrated in positions that blow up during crises. Let's start with index fund providers, companies like Vanguard, BlackRock, State Street. Now, before you think I'm going full conspiracy theory here, understand their business model. They make money based on assets under management. The more money you've invested in their funds, the more they collect in fees. It's a tiny percentage, maybe 0.04% or 0.1% annually. But when you're managing trillions of dollars, those tiny percentages become billions in revenue. Here's their incentive structure. They want you to invest as much money as possible and never sell. They don't care if you make money. They care that you stay invested. The perfect narrative for them is the one they've been pushing for 20 years. Buy the index, hold forever. Don't try to time the market. Don't worry about valuations. Just keep dollar cost averaging into our funds no matter what. Why? Because if you sell during a crash, they lose assets under management. If you move money into Treasury bills or gold or anything else they don't manage, they lose revenue. Now, here's how they hide this conflict of interest. They publish research showing that market timing doesn't work, that active management underperforms, that the best strategy is passive indexing. And you know what? A lot of that research is technically true under normal market conditions. but it completely ignores what happens during crises. It ignores the fact that when the market drops 50%, your index fund drops 50%, and their revenue only drops based on their assets under management, not their own capital. You lose half your wealth. They lose half their fee revenue, but none of their own money. The incentives are completely misaligned. They need you to believe that holding through crashes is virtuous, that selling is market timing and therefore bad. But the reality is that selling during obvious bubbles and moving into safer assets isn't market timing. It's risk management. It's exactly what institutional investors do with their own money while telling you to stay fully invested. Then you have the brokerage firms and financial advisors. Their incentive is even more direct. Most advisors are compensated based on a percentage of assets they manage for you. If you move money out of stocks and into treasury bills, they make less money. If you buy physical gold, they can't custody it and charge you fees. If you invest in individual commodity producers instead of broad market funds, it requires actual research and work, which cuts into their profit margins. So what do they tell you? Stocks for the long run. Time in the market beats timing the market. Don't react emotionally to crashes. All of which keeps you fully invested in products they can charge fees on while taking zero personal risk. Here's the method they use to keep this going. They reframe losses as temporary setbacks and gains as proof the system works. When the market crashes, they tell you it's a great buying opportunity, that downturns are normal, that you should stay the course. When the market recovers, they take credit for keeping you invested and point to the rebound as proof their strategy works. But they never, ever acknowledge that you could have avoided the drawdown entirely by moving into safer assets before the crash. They never show you the math on what your portfolio would look like if you had shifted into treasury bills in February 2008 and avoided the 60% collapse. Because if they did that calculation, you'd realize you could have preserved your capital, earned safe returns, and bought back into stocks at the bottom with way more purchasing power. So here's the emotional reframe you need to make right now. You are not a passive investor who needs to accept whatever the market does to you. You're an active decision maker with the ability to move capital into positions that survive crises. The people who profit during crashes aren't lucky. They're not geniuses. They simply recognize patterns and act on them before the crowd does. Every major crisis since 1929 has followed the same pattern. Assets that depend on leverage, growth, and optimism collapse. Assets that provide safety, real value, and essential resources survive or thrive. This isn't complicated. It's just hidden from you because the financial industry makes more money when you don't know it. Now, let's get specific about the 3 positions that have survived every crisis since the Great Depression. And I mean specific, with actual numbers and real examples, because vague advice is useless. Position number 1, short-term treasury bills during periods of rising interest rates or economic uncertainty. Here's what most people don't realize. When you hear financial advisors talk about bonds, they're usually referring to long-term bonds, 10-year or 30-year treasuries, or worse, corporate bond funds. Those are completely different animals than treasury bills. A treasury bill is a government obligation that matures in 1 year or less, usually 90 days or 6 months. When the economy is unstable, when inflation is rising, when stock markets are overvalued, treasury bills give you 3 things simultaneously. First, absolute safety. They're backed by the full faith and credit of the US government. Short of the entire country collapsing, you're getting your money back. Second, liquidity. You can sell them instantly without loss of principal if you hold to maturity, or with minimal price fluctuation if you sell early. And third, competitive returns during periods of high interest rates. Let me give you the exact numbers from past crises. During the 2008 financial crisis, the stock market dropped 57% from peak to trough. If you had $100,000 invested in the S&P 500 inches October 2007, you had $43,000 by March 2009. Devastating. But if you had moved that $100,000 into 6-month treasury bills in October 2007, here's what happened. At that time, 6-month T-bills were yielding around 3.5%. Not exciting, but stay with me. By October 2008, as the crisis intensified, T-bill rates briefly spiked to over 4% as the Fed was still trying to control inflation before they pivoted to cutting rates. Your $100,000 would have earned about $3,000 to $4,000 in interest while preserving all your capital. But here's the real power. In March 2009, when stocks had crashed 57%, you still had your $100,000 plus interest. You could have then invested that into stocks at the absolute bottom. Your $100,000 would have bought more than twice as many shares as it would have in October 2007. When the market recovered to its previous peak by March 2013, you wouldn't have just recovered your losses. You would have more than doubled your money. The same pattern played out during COVID. In February 2020, if you recognized that a global pandemic was going to crater the economy and move your portfolio into Treasury bills, you avoided the 34% drop in March. Treasury bills were yielding around 1.5% at the time. Not much, but you preserved capital. Then, when stocks bottomed on March 23rd, 2020, you could have redeployed at a massive discount. By August, the market had fully recovered. If you had stayed invested, you went on a terrifying roller coaster and ended up roughly where you started. If you had moved to T-bills and bought the dip, you locked in a 34% gain in 5 months. Now, you might be thinking, but David, that requires market timing. You have to know when to sell and when to buy back in. And you're right, it does require making decisions. But here's what nobody tells you. You don't have to time it perfectly. You just have to recognize obvious extremes. In February 2008, the stock market was at all-time highs, housing prices were clearly in a bubble, and credit markets were showing serious stress. You didn't need to predict the exact top. You just needed to recognize that valuations were extreme and risk was elevated. Same with COVID. In late February 2020, a virus was spreading globally, countries were locking down, and supply chains were freezing. You didn't need to know the market would bottom on March 23rd. You just needed to recognize that a global pandemic was probably bad for stock prices and move to safety. Position number 2, physical gold or gold-backed securities during periods of currency debasement and inflation. Here's the thing about gold that drives modern financial advisors crazy. It doesn't produce cash flow. It doesn't pay dividends. It just sits there. And in normal economic times, that's a valid criticism. But during crises, especially crises involving inflation or currency problems, gold is the only asset that maintains purchasing power. Let me show you exactly how this played out. During the 1970s, when the Nifty 50 was collapsing and inflation was destroying bond returns, gold went from $35 per ounce in 1970 to over $800 per ounce by January 1980. That's a 2,200% gain in 1 decade. If you had put $10,000 into gold at the start of 1970, you had over $220,000 by 1980. Meanwhile, the stock market was basically flat for the entire decade after adjusting for inflation. Bonds lost massive purchasing power as inflation ate away at fixed returns. Gold was the only major asset class that not only preserved wealth, but dramatically increased it. Fast forward to 2008. From March 2008 to March 2009, while stocks were collapsing, gold went from around $900 per ounce to over $1,000 per ounce, then surged to over $1,900 by September 2011 as central banks flooded the system with money. If you had moved $50,000 into gold in March 2008, you had over $100,000 by September 2011, a complete doubling while stock investors were still recovering from their losses. During COVID, the pattern repeated. Gold started 2020 at around $1,500 per ounce. By August 2020, it hit over $2,000 per ounce as the Federal Reserve printed trillions of dollars and real interest rates went deeply negative. A 33% gain in 8 months while providing complete safety from stock market volatility. Here's what makes gold so powerful during crises. It's nobody else's liability. When you own stock, you own a claim on a company's future earnings. If the company fails, your stock is worth 0. When you own bonds, you own a promise that someone will pay you back. If they default, you lose money. When you own dollars in a bank, you own a liability of the banking system. If banks fail or currency is debased, your purchasing power evaporates. But when you own physical gold, you own an asset that has been recognized as valuable for 5,000 years, that can't be printed or created out of thin air, and that every central bank in the world holds as a reserve asset. During periods when trust in financial institutions collapses, when currencies are being devalued, when inflation is destroying purchasing power, gold is the only thing people universally trust. Now, here's the specific action step for gold. You don't need to put your entire portfolio into gold. That's not the point. But during periods of obvious monetary expansion, when central banks are creating trillions in new currency, when inflation is rising, when real interest rates are negative, having 10 to 20% of your liquid net worth in physical gold or gold-backed ETFs like GLD gives you insurance that actually pays off when you need it. The key is physical gold or securities that are fully backed by allocated physical gold. Not gold mining stocks, which are leveraged bets that can collapse even when gold rises. Not gold futures, which require constant rolling and can lose money in contango markets. Physical gold, or direct ownership through allocated ETFs. Position number 3, shares in essential commodity producers during periods of supply, disruption, or inflation. This is the position that almost nobody talks about, but it's been the most profitable during certain crises. Here's the logic. During normal economic times, commodity producers are boring, cyclical businesses that don't get much attention. But during crises involving inflation, supply chain disruptions, or resource shortages, these companies become printing presses. They own physical assets that produce things the economy desperately needs, and they can raise prices to match or exceed inflation. Let me give you the exact playbook from the 1970s. Between 1973 and 1974, when the Nifty 50 was collapsing, energy stocks were soaring. The Arab oil embargo created massive supply shortages. Oil prices quadrupled from around $3 per barrel to over $12 per barrel. Companies that produced oil saw their revenues and profits explode. If you owned shares in major oil producers during this period, you weren't just protected from the stock market crash. You were making massive returns while everyone else was losing money. Exxon's stock price more than doubled between 1973 and 1974. While the overall market was in free fall, the same pattern played out in 2008, but with a twist. In the first half of 2008, as the housing bubble was bursting, but before the full financial crisis hit, commodities went parabolic. Oil hit $147 per barrel in July. Agricultural commodities like corn and wheat hit all-time highs. Investors who recognized that inflation was spiking and moved into commodity producers made enormous returns, even as financial stocks were collapsing. Then, when the full crisis hit and demand collapsed, commodities crashed too. But here's the key. If you had rotated out of commodity producers in mid-2008 and into Treasury bills, you captured the gains and avoided the crash. During COVID, the pattern was even more dramatic. In March and April 2020, oil actually went negative. Producers were paying people to take oil off their hands because storage was full and demand had vanished. But by late 2020 and into 2021, as economies reopened and supply chains were constrained, commodity prices exploded. Oil went from negative prices to over $120 per barrel by March 2022. Natural gas prices in Europe increased by over 500%. Companies that produce these essential commodities saw their stock prices double, triple, or more. If you had bought shares in a major oil producer like Chevron in April 2020, when it was trading around $70 per share, you could have sold in June 2022 at over $180 per share. A 150% gain in 2 years while also collecting a 4% dividend yield. Here's why this position works during crises. Essential commodities are things the economy can't function without. Energy to power factories and transportation. Agricultural products to feed people. Industrial metals to build infrastructure. When supply is disrupted or when inflation makes everything more expensive, these producers have pricing power. They can pass costs on to customers because customers have no choice but to pay. And unlike financial assets, which are just claims on future cash flows that can evaporate, commodity producers own physical assets in the ground. Oil reserves, natural gas fields, copper mines. Those assets have tangible value regardless of what happens in financial markets. The specific action step here is more nuanced than just buying commodity stocks randomly. You need to recognize when conditions favor commodity producers. Those conditions are rising inflation that's eroding the value of financial assets, supply chain disruptions that are constraining availability of essential resources, or massive monetary expansion that's going to eventually show up in higher prices for real goods. When you see those conditions developing, allocating 10 to 20% of your portfolio to shares in high-quality commodity producers gives you exposure to one of the few asset classes that benefits from the chaos. Now, let's talk about why these three positions work together and how you actually implement this in real life, because theory is useless without execution. The power of these three positions is that they're counter-cyclical to each other and to traditional stock and bond portfolios. Treasury bills perform best when interest rates are high or rising and when safety is in demand. Gold performs best when real interest rates are negative and when currency debasement is occurring. Commodity producers perform best when inflation is rising and when supply constraints create pricing power. Stocks perform best when economic growth is strong, interest rates are low, and optimism is high. Bonds perform best when interest rates are falling and inflation is low. Here's the implementation framework. During periods of economic stability, low inflation, and reasonable valuations, you can hold a traditional portfolio of stocks and bonds. Boring, but effective when conditions are favorable. But when you start seeing warning signs, when stock valuations reach extremes, when central banks start creating massive amounts of new money, when inflation starts rising, or when supply chains show serious stress, you shift allocation into the three crisis positions. You don't have to go all or nothing. You don't have to sell everything and buy gold bars and hide in a bunker. You just need to recognize that risk is elevated and shift your allocation accordingly. Maybe that means going from 80% stocks to 40% stocks, 30% treasury bills, 15% gold, and 15% commodity producers. The exact allocation depends on which specific risks you see developing. If you're worried about stock market valuation but not inflation, emphasize treasury bills. If you're worried about currency debasement and central bank money printing, emphasize gold. If you're worried about supply chain disruptions and resource shortages, emphasize commodity producers. Let me give you a concrete example of how this would have worked in practice over the last 25 years. In 1999, the dot-com bubble was reaching absurd levels. The Nasdaq was trading at over 100 times earnings. Companies with zero profits were valued at billions of dollars. If you recognize this as an obvious extreme and shifted from 80% stocks to 40% stocks and 60% treasury bills, here's what happened. The Nasdaq crashed 78% from March 2000 to October 2002. If you had stayed fully invested, your $100,000 portfolio dropped to $22,000. Catastrophic. But if you had shifted to 60% T-bills earning around 5% annually, your $100,000 became $40,000 in stocks that dropped to around $9,000, and $60,000 in T-bills that grew to about $69,000 over 2.5 years. Total value, $78,000 instead of $22,000. You still lost money in the stock portion, but you preserved most of your capital. Then, in October 2002, you move back to 80% stocks at the bottom. Your $78,000 becomes $62,000 in stocks. When the market recovers to its previous peak by October 2007, your $62,000 in stocks is worth about $140,000 because you bought at a huge discount. Fast forward to 2007. Housing bubble is obvious. Credit markets are showing stress. You shift again, this time to 40% stocks, 40% treasury bills, 20% gold. Stocks crash 57%. Gold rises from $700 per ounce to over $1,900 by 2011. Treasury bills preserve capital and earn about 3 to 4%. Your portfolio not only survives the crash, but actually grows because the gold position more than offsets the stock losses. Then you rotate back into stocks at the bottom in March 2009, and you capture the entire recovery with more capital than you started with. COVID hits in 2020, you recognize a global pandemic is going to destroy economic activity short term. You shift to 30% stocks, 50% treasury bills, 20% gold. Stocks drop 34% in 1 month, but then recover. Gold rises 33%. Treasury bills preserve capital. You avoid the emotional trauma of watching your portfolio collapse, and you have dry powder to buy assets at the March bottom if you choose to. Here's the cumulative effect. If you had started with $100,000 in 1999 and just bought and held the S&P 500, you'd have around $600,000 today after all the crashes and recoveries, assuming you reinvested dividends and never sold during the drawdowns. Not bad over 25 years. But if you had actively shifted between stocks and the 3 crisis positions during obvious extremes, avoiding just the worst of the dot-com crash and the 2008 crisis, you'd have well over $1 million. The difference is massive, and it didn't require perfect timing. It just required recognizing obvious bubbles and moving to safety before they popped. Now, here's what you need to do right now, today, to start implementing this. First, calculate your current exposure to concentrated positions. Look at your portfolio. What percentage is in the top 10 holdings of your index funds? If you own the S&P 500, check how much is in Apple, Microsoft, Amazon, Alphabet, Tesla, Meta, and Nvidia. If it's over 25%, you're not diversified. You're concentrated in a handful of technology companies that all depend on the same economic conditions. That's not safety. That's a crowded trade waiting to collapse. Second, assess current economic conditions against the crisis checklist. Are stock valuations extreme compared to historical averages? Is the Federal Reserve creating massive amounts of new money? Is inflation rising faster than interest rates, making real rates negative? Are supply chains showing serious stress? You don't need all of these to be true. Even 2 or 3 should trigger a defensive shift. Third, open accounts that give you access to the 3 crisis positions. You need a brokerage account where you can buy treasury bills directly, or through ETFs like SHV or BIL for short-term bills. You need the ability to buy gold through an allocated ETF like GLD, or physical gold through a dealer like APMEX. And you need the ability to buy shares in commodity producers, either individual companies like Chevron or Exxon, or through sector ETFs like XLE for energy. Fourth, set up a quarterly review process where you honestly assess whether conditions favor offensive or defensive positioning. This doesn't mean trading constantly. It means every 3 months, you spend an hour looking at valuations, inflation data, central bank policy, and supply chain indicators. If conditions are favorable, stay invested in growth assets. If conditions are risky, shift to the 3 crisis positions. It's not complicated. It just requires discipline and a willingness to act against the crowd. Here's the final thing you need to understand. The financial industry has spent decades convincing you that you're not smart enough to make these decisions, that you need to just buy the index and hold forever, that any attempt to avoid crashes is market timing and therefore doomed to fail. That narrative serves their interests, not yours. They make money when you stay fully invested in products they manage, regardless of whether you make money or not. The reality is that recognizing obvious extremes and shifting to safety isn't market timing. It's risk management. It's exactly what wealthy individuals and family offices do with their own money. And the 3 positions I just showed you, treasury bills, gold, and commodity producers, have a 95-year track record of surviving and profiting during crises when everything else collapses. This isn't theory. It's historical fact. The only question is whether you're going to act on it before the next crisis hits, or whether you're going to stay concentrated in positions that have failed every single time conditions shift.